How did a couple making over $300,000 a year with a sub 3% mortgage wind up one credit card swipe away from divorce? And how did one weird loan rule save both their wallet and their marriage? Welcome back to the Loan Lab. Let's crack this file wide open. Here's a scenario. Basically, I've been working with this couple for 5 years, and I got a phone call from them, and it was pretty disheartening. They were considering divorce and splitting their assets and wanted to know what a refinance would look like, and kind of digging more into what was going on, what was causing the issue. Basically, they were living on credit cards and they were maxing out all their credit cards. And so they had this massive amount of debt that they had racked up. It was around like more than $7,000 a month just in credit card. We're not talking mortgage. We're not talking insurance on your cars or whatever, cell phone bills, literally just credit cards. Quite a bit, $7,000 a month. And so the kind of the straw on the camel's back was they had this medical emergency and they needed some money fast. And so they were just scrambling and struggling. And the Loan Lab, the purpose of this video is kind of give you guys an insight into loan officers' minds when they're helping, or at least our minds, the way we do things when we're helping our clients out. And so the things that we always want to consider as a loan officer, because really we're the loan officer, we're this in between of the lender and what lenders are considering, and then the borrower and where they're at, and how do we position them in a way that's attractive to a lender. And so we have to ask the borrower all these kinds of questions. Where's your credit? What's your income? What's your assets? So I'm going to go a bit backwards in here. Assets, basically like things that add to your net worth, right? This family had a $1 million home. I had helped them get this mortgage. It was less than a 3% mortgage. And so the way rates are looking at, like, we could refinance that mortgage, but rates right now are in the 6, 7, 8% range. And we did not want to touch that at all if possible, because that would, like a 2.9, that's like trading like a Bentley for a bus. Like, you just don't want to touch that right now. We could, but didn't want to. The other thing was retirement savings. They had a 401k, a Roth IRA, things like that. The issue is if we draw money from those accounts, there are tax penalties. And I'll be honest, I am not a licensed CPA, and I'm not going to give any more advice other than that. But basically, there's two things that we could draw funds from, but it would probably not turn out well. But worst case scenario, definitely could do that. Now, the interesting thing about this couple is both the husband and wife earn over $150,000 a year. And so combined, they're making $300,000. And so sometimes as a loan officer, I'll say, okay, what can we do to boost your income? Or can you ask for a raise? Can you get a second job? Is there another company that can pay you for what you currently do, but pay you more? That wasn't really an issue in this scenario. This couple made fantastic money. And to be honest, they have a hole in their pocket. They spend way too much. And that medical emergency was, again, kind of the straw on the camel's back. And so looking into the credit, this is where the big issue was. I've kind of alluded to. They had more than 20 credit cards. And when you look at the different rates of credit cards, and I would actually challenge you, look at when you opened your credit card and what the interest rate was, and it'd probably shock you, but the average credit card rate that they had was around 23%. Some of them were as low as like 20%. Most credit cards don't go much lower than that. Some of them were up to like 30, 35%. So they just spend out the wazoo when they max out one and they say, okay, let's go to this next one and max out. But they make a lot of income that they can kind of pay these off a little bit, but it was putting the stranglehold on them. And so we had to look around to see what we could do to help this couple out. It was actually getting really scary. I'd submitted them what we wanted to do, instead of refinancing the mortgage on their primary residence at beautiful 2.94%, we wanted to get a HELOC, a home equity line of credit, and that's basically a second mortgage tied to the same property. And really what we're doing is we're swapping credit card interest rates in the 20, or for them, the average one was like 23%, for more of a mortgage or a home interest rate, or a HELOC interest rate, which was going to be like 12, 10, 11, 9%, like literally cut it in half. and cut their payments in half. And so we started looking at different lenders and submitting their application to different lenders, and we kept getting denied. And the reason why we were getting denied is because when it comes to credit, both couples have credit, right? They have credit cards, and then a credit is just a score of trust. It's a unbiased score of what's your ability to pay people back. And so for one spouse, their score was in a decent range that we could use. The other spouse didn't have a great score. And so more and more lenders are like, I don't think you're going to pay me back. I'm not going to give you money. And we got denied twice with lenders. And just so you're aware, when lenders look at a couple, they look at whoever has the worst of the two credit scores, and they say, okay, what's the middle FICO score? What's kind of the average score that this person has? That's what we're going to base our lending on for this couple. We're going to assume the worst case scenario. Lenders are very risk adverse. And so no traditional lender would do it. And so you have like lenders in the box, and they have better terms. If you can fit in this box, you get better terms. And that's what our course is about, how to fit in this box and become attractive to a lender. They didn't fit. So we had to look outside the box, and we would call that, in my world as a loan officer, we call that non-QM, non-qualifying mortgage. Basically, these lenders, they kind of make their own rules. They say, I'll lend you money, but it's going to be the way that I like to do it, the way I feel comfortable. And the nice thing is they can expand their box a little bit of what they find acceptable. And so for this couple, we found a lender that would give them a HELOC, and instead of looking at the worst credit score of the two, they looked at the best credit score of whoever earns more. And it just so happened that this client, the spouse that had the better credit score, earned more, and so they got better terms. Ultimately, we were able to save this couple $4,304 a month for the first 3 months. They had this non-QM lender. They had this special deal where basically the first 3 months the interest rate would be lower, and then the rest of the term, the interest rate would go up a bit. So payments. So basically they're saving $4,300 a month for 3 months, and then for the life of the HELOC, $3,362 a month. Can you imagine spending that, but let alone saving that $3,362 a month? So basically, we paid off all these credit cards, all the ones that we could. We couldn't pay them all off, believe it or not. But we were able to basically trade, and that's what my job is. It's looking at interest rate. People say like, oh, you help people buy houses. Yeah, I help you. Like, I take it seriously that I help people get into the biggest debt that they ever probably have, but then I have to help you navigate that debt or use that as a tool. And so we traded the 23% credit card interest rate for a HELOC rate, significantly lower, like slashing their monthly payments in half. And so my advice to them is, you have 3 months where you're saving way more money than you're kind of used to, and we weren't able to pay off all your credit cards. So one, let's pay down your remaining credit cards, because it was hurting one spouse's credit so much because they were getting maxed out. So let's get them in a better situation so their credit score can get better. Because again, we're in a non-QM loan. Eventually we can refinance into a qualified mortgage, a normal loan, and they have even better terms. And this couple could save another like $500 a month, $6,000 a year. Like, sign me up. But we can't be spending out the wazoo anymore. So pay down remaining credit card. And the thing I noticed with this couple, like they don't really have a lot in savings. They do a great job in retirement, but like money that could be available for an emergency. And honestly, I've helped this couple for 5 years, and I've seen a couple emergencies where the HVAC system goes out in the middle of summer, or a medical emergency, or medical emergency for a pet. And so thankfully we're able to navigate this situation to help this couple out. But it was scary. I guess my biggest thing is use your home like a tool. Like, if you have the opportunity to trade credit card debt for a home equity line of credit, it doesn't always make sense, but it might. And so talking to a loan officer is always a good suggestion. I love talking to people, and I talk to people all the time, getting advice, and I don't have to help them on a deal, but at least kind of point them in the right direction of where can we save money on our interest payments. And anyways, that's kind of the Loan Lab, and I hope you guys learn from that, and we'll see you next week. Start your HomeQuest.